5 routes of investing into the stocks. What are these 5 routes, and is there an advantage among each of these 5 routes? Let us understand all these 5 routes first. Let us see these 5 routes, what are the advantages of each of these route and the disadvantages as well, and then finally I will conclude to summarize which of these routes would be most beneficial to you as an investor for for the purpose of meeting certain financial need or for the purpose of growing wealth if you have already met your certain needs. So let us see what are the 5 routes, and please share it to your friends and everybody so that they can also understand what are the 5 routes of investing and apply what is more comfortable to them depending on their current financial position, whether they have met the need or whether going to meet the financial need, or if they already met the need, then moving towards wealth accumulation and protection. So this is Navito here, and I have been investing since past 13 years, and I've written a book on investing and how you can dodge the recession and how you can secure a financial powerhouse for yourself, so that give it any situation in the financial world, you will be able to tackle that particular situation. So do read the book, and let's see forward in the video what are the 5 routes of investing. So the first route of investing is direct route of investing, wherein you can purchase stocks directly from the stock exchanges. The second route of investing is the mutual fund house. The third route of investing is your ETF, exchange traded fund, and then you have UITs, unit investment trusts. And then you also have PMA or SMA. It is separately managed accounts or privately managed accounts. So let's see what are these different routes of investing, what are the advantages and disadvantages. So the direct route of investing is the first route. Obviously, you need a thorough understanding about the financial world. You need to have a great degree of knowledge about finances. So it requires you to understand financial statements of the company, read through profit and loss, understand profitability, read through balance sheet, understand stability, financial stability of the company, and then also read through cash flow to understand how the company is burning cash. Is it able to retain cash after purchasing all its tangible and intangible assets? So it is important, right? And then finally, once you have read through all these financial statements, then you have to come to a position where to understand the intrinsic value and purchase the stock depending on the current price, suiting your current rate of return. So that is required for direct investing into the stock market. Apart from that, you also need to understand the future view of the company, how the future prospect about its product, and also the management of the company. Various aspects you have to study about the company to a great degree, almost being like a fund manager of your own fund house. You have your own personal finance company, and you are the fund manager of the particular company, which is helping you to grow wealth for yourself. So it's a great thing, but it requires all these complex studies, which requires time, obviously, which you may not have if you are working. But if you do have, it's a great advantage to study all this and then invest. Disadvantage, as I told you already, it's like time consuming and it requires a lot of knowledge about the financial world. So that's about direct investing. The second part is mutual fund house, wherein it's a mutual fund trust. Basically, it gathers investors' money from different public or a section of the public depending on the mutual fund scheme. So once it collects this money, it then invests this money as though you are the fund manager itself for the particular house. So that means you have a fund manager for the mutual fund body under the AMC, and they invest your money into stocks depending on the various visibility insights they have into the financial statements, which you would have done otherwise if you invest directly into the stock. Obviously, the fund manager, being experienced in the financial world, will have a great knowledge about the finance domain, and also to read different financial statements, have certain kind of insider information as well. When I say insider information, it's about the growth prospects of the company, how the management is, management faith on their own company and products. All this visibility is there. They also get to talk to the management. Not that as an individual investor you don't get an opportunity to talk. You have to take that additional effort to talk. But as a fund manager, they have this proximity to different companies and the management as well. So that is the advantage you get by investing through the mutual fund. But the slight disadvantage, you have to pay for the expenses. You have to pay for the fund house key personals. They have to also work for you on your behalf. Instead of you studying the annual statement, they have to study the annual statements of the company, and they also have this expenses which they have to incur to run and manage the different monies to be invested in the companies. So the mutual fund house usually charges about 1% to 2% as an expense ratio on a year-on-year basis. And for every transaction which you do, they do have some kind of a fees. It depends on which is the scheme you are investing. And then if you exit, you have to pay certain load, wherein you have to pay whatever you exit, you have to pay like a 1% fee. Depending on the duration you are invested in the mutual fund. And there is entry criteria as well in certain mutual fund scheme, but in India, I guess, as far as my knowledge is concerned, there is no entry fee involved to invest into the mutual fund. So that's about mutual fund house. And then you have ETFs. ETF are exchange traded funds. So ETFs mimic exactly a particular index. It could mimic index like a Nifty or a Sensex. ETFs can also be formed to track the performance of the specific index. So the investors could invest into the ETF. The fees involved in buying ETF, the expense cost for yourself as an investor is about 0.1, because they just mimic the existing index. They don't have any additional activity to do. They don't have additional financial analysis to do if they mimic the index thoroughly. But then they have some ETFs, there are some ETFs which mimic a sample of the index. You will see or notice a tracking error, but nevertheless there is some degree of tracking error depending on demand and supply of the ETF. So it could be like 0.5% tracking error with that of the index, could be positive or negative. So that's about ETFs. And then you have unit investment trust. So unit investment trust and mutual fund is almost likewise, just that in mutual fund houses which are open-ended, or it could be even closed-ended mutual funds. But unit investment trusts are more of a closed-ended mutual fund wherein they invest into companies, and then once they have invested, and then they have a certain maturity period for the particular investment. So investors could the sponsor puts their own corpus into the investment and then sells this as an offering to the investors. And then once the investors buy this, then they most likely stay on until they want to sell it. They are being offered in the secondary market. But there are no more new positions which can enter into the unit investment trust. So more or less the investors get to know what they are expecting of the unit investment trust as part of returns, as well as part of the duration. They know how much time to wait. So that is the unit investment trust. The advantage is that they don't have too much of churn out of the portfolio. They don't sell in and off, even in fact negligible. They just stick on to what they have invested on day one. And then the fund manager, who is involved only at the beginning of the unit investment trust, is no longer involved. So the expense cost of the unit investment trust is much lower compared to that of a mutual fund house. So that's about unit investment trust. And then you have this PMA and the SMA, that is your separately managed account. This is mostly catered towards high net individuals, wherein they have a trading platform, wherein they have to pay some nominal fee, and it is managed privately by a financial advisor who caters to specific HNIs. And depending on the HNI's requirement, they have this investment scheme wherein they document what is the requirement of the HNI, what is the expected rate of return, what kind of companies they want to invest. Some of them might want to stay away from tobacco companies, some of them might want to stay away from real estate companies, because of a specific kind of mindset against tobacco or even drug companies, as a matter of fact. So depending on their particular requirement, they set an investment strategy with the financial advisor, and based on that, the financial advisor would invest on their behalf, or even and they have full visibility of every stock being invested. Unlike the mutual fund house, you need to see every month what are the changes in the in the companies being acquired or companies being sold, and you don't have much say in what the mutual fund house actually does. But in the PMA and the SMA, you have more say, and you can actually direct the financial advisor or financial planner to do as per your need. So that's the advantage of a PMA more, and you have the advantage that you can move forward the losses which you incur. For example, if you have incurred a loss today by investing in certain companies, then later on down the line, like about 8 years down the line, if you have gained from a particular asset sale, then you can adjust the gains against the profits, that is the capital gains. So that's the advantage which you get from a PMA and a SMA, and most of them charge a fee to the HNI. They might also charge a fee depending on the amount of returns they might give above the benchmark. For example, they might have a hurdle rate wherein if it is like if you meet about 12% of your returns, then above that they charge a fee. The client interest is the utmost important, which is given by the financial advisor. Most cases, if it is a certified financial advisor, only then he would have a trading platform for the HNIs. So these are the 5 routes of what you can choose to invest. If you are an HNI, obviously you would want to go for a PMA or a SMA route, which is which will have more say for yourself, and you could reduce your tax complications as well. And if you are an individual investor, which you are starting your investing journey, then I believe either a mutual fund or a ETF route is the best suitable route. I know that mutual fund houses do charge a fee, but then also you need to remember that whatever mutual fund houses sell and buy within its own mutual fund, you're not applicable to pay capital gains on that unless you have sold the units of the mutual fund. That's the advantage which you get. You get a capital gain tax benefit, as a matter of fact, if you invest in mutual fund compared to that of ETF, wherein you will be applicable to capital gains if you are inclined to sell or buy various times during the year. But nevertheless, if you are investing in ETF, that is also a great route. If you know when to buy into ETF when they are undervalued, and then wait for a long duration of time to meet your financial route, my preference would be ETFs and mutual fund, 50-50 ratio, as a matter of fact, to take advantage of the fund manager as well, and also do a passive investing into ETF. So you could choose from these 5 different routes, and if you're interested in direct investing, you can drop a note and I'll be glad to help you out in direct investing. I have done direct investing for myself. It's a great way to invest, and if you're a long-term investor, then there's nothing much to lose if you're a long-term. If you're a short-term investor, then in fact investing itself is not a game to enter. So that's all I have to say in this specific video. So hope you have enjoyed it, hope you have understood different routes, and hope you are able to make a decision for yourself.